Hello there, I'm Amira David. This is Boom Bust, and these are the stories we are tracking for you today. British oil giant BP announces an additional 3,000 job cuts after $5 billion of loss in 2015. That's what they just reported. Plus, a new study says the refugee crisis could cost Germany more than 50 billion euros by the end of next year. I've got the details on all of that coming right up. Then Jim Rickards is on the show. He'll tell us what he thinks that China should do in the face of its foreign exchange reserves crisis. Then in today's Big Deal, Ed Harrison and I are talking about investments as European corporate bonds edge closer into negative territory. We've got that and a whole lot more on the show today, so make sure you don't go anywhere because it all starts right now. We begin today with more bad news out of the oil and gas sector. British Petroleum has just posted its biggest ever annual loss, and it's set to cut another 3,000 jobs. Keep in mind, that number is in addition to the 4,000 jobs it announced it would eliminate less than a month ago, about 3 weeks ago. So now it plans to shed 7,000 jobs total by the end of 2017. The restructuring came after the company reported a $5.2 billion annual loss compared to the $8.1 billion profit it made just a year prior in 2014. Some of that reversal, analysts say, is due to charges related to the fallout from the 2010 Gulf of Mexico disaster. But we also know much of this is due to the 20-month slide in oil prices. It's really wreaking havoc across the entire energy industry. BP is hardly alone in its losses. Small, medium, and large-size oil companies have been slashing spending over the last several months. Chevron just recently announced a $588 million loss for Q4, warning of a fresh round of expense cuts. And just today, ExxonMobil reported a 58% drop in earnings for Q4, its lowest level since 2002. And moving right along here, a new study out of Germany now says the refugee crisis will cost the country 50 billion euros by the year 2017. The report issued by the Cologne Institute for Economic Research says that shelter, welfare, and integration will leave Germany with a bill of roughly 22 billion euros in 2016 and 27.6 billion the following year. Keep in mind, more than 1 million migrants registered in Germany in 2015. Germany is Europe's largest economy, and it's a magnet for migrants who are seeking out job opportunities and good social benefits. But authorities are now struggling to keep up with the influx. Not only is it putting a strain on the country's finances, it's also challenging the existence of the region's economic lifeline. That is, of course, the Schengen zone. If the EU allows for any kind of suspension of that zone, which it has been considering, that could severely interrupt commerce. One German institute says it could deal a huge blow, $1.1 billion per year to German-Austrian trade alone. We'll continue to follow that story and bring you any updates. Senator Bernie Sanders, also a Democratic candidate, constantly makes headlines for his position on economic issues, whether it's the minimum wage, taxes, or student debt. RT's very own Ed Schultz spoke with Sanders in Iowa just before the caucuses took place, and he began by asking him about his position specifically on student debt, how that has really helped shape his campaign. Take a look.
We started this campaign, as you'll recall, at like 40 or 50 points behind Hillary Clinton.
Yeah.
And the last polls have us about even. I think there are a lot of reasons. I think we are, as you did on you have done for years. We're talking about the reality of the American economy, a middle class which is disappearing, people working longer hours for low wages, Almost all new income and wealth go into the top 1%, and in terms of young people.
But do you think that that tuition theme that you've had
Absolutely.
Has struck them? Because that's the economic component in all of this.
Look,
and they'll turn out for that if they vote
I think they will.
Right?
I think they will. Look, in the year 2016, a college degree in many respects is what a high school degree was 40 or 50 years ago, correct?
Yeah, yeah.
Right? The kids need it to get a decent job. I talk to kids all over the state. They are deeply in debt. Talked to a kid just 2 days ago. Kid is $60,000 in debt after 2 years of college. That's insane.
Another issue, Senator, we're 25 miles from Newton, Iowa, where Maytag,
Yep.
the Maytag repairman used to be.
Yep.
He's in Mexico now.
I know.
Those people went across the street to work at the wind plant, and they're making half of what they used to make. I mean, is that in Iowa? I mean, isn't it about jobs?
I talk about it every day. And, you know, you and I know that the media does not like talking about trade, right?
Yeah.
And
well, I mean, this is right in the middle of the country. Do they get it?
Oh, the people get it. Absolutely, they get it. I speak about it almost every speech. Look, we have lost 60,000 factories since 2001. 60,000, millions of jobs. Not all of it attributable to trade, but a lot of it. Of course, people get it. And they know that it's part of the race to the bottom. It's why the jobs, just the point you made. They lost good-paying jobs. Maybe they get another job, half the wages.
If you win Iowa and New Hampshire, is it a game changer?
Oh, God, yes. Absolutely. I mean, I think, look, when we began this campaign, we were a fringe campaign, and Hillary Clinton was the inevitable candidate, right? That is changing, and it's changing all over the country. We have support, not only here in Iowa and New Hampshire, but in state after state. We're doing really well.
And finally, Senator, establishment. Does that word bother you? Because every issue that you're on polls in the majority, yet they say, well, Bernie, you know, he's not the establishment guy. What's the establishment?
Well, what we got is you're right. This is the irony. Every issue we talking about, creating jobs, raising the minimum wage, pay equity for women, making sure that the young people can go to college tuition-free in public colleges and universities, climate change. All of these issues are issues that the American people believe in.
Yeah.
Meanwhile, you go to Congress, oh, these are terribly radical ideas. You know what? The American people do want to ask the wealthy and the powerful to stop paying their fair share of taxes.
The people on the campaign trail, do they believe you can break up the banks? Do they believe you could do something about Wall Street? Or they just
I think
want
they
to
do.
hear it?
But the point that we make over and over again, Ed, is that I can't do it alone. No president can do it alone. That's why the title, if you like, the subtext of this whole campaign is a political revolution. No one can do it alone. We need to do it together.
All right, that was RT's Ed Schultz with Senator Bernie Sanders. Make sure to stay tuned for more of Ed Schultz's upcoming special coverage on the student debt crisis, airing Wednesday at 8 p.m. Eastern. Now, uncertainty over the potential for a British exit from the European Union, also known as a Brexit, is causing concern among investors and British citizens alike. But with negotiations still ongoing between the UK and the EU, rifts within Parliament are growing wider over the terms of EU membership. This week, European Council President Donald Tusk presented a document outlining a set of concessions for the UK in an effort to make EU membership more appealing. But do the concessions go far enough? RT correspondent Manuel Rapolo has been tracking this story, and he joins me right now. So, Manny, let's start with these concessions. I mean, what do they really entail?
Sure. Well, we've been hearing a lot about these negotiations getting more serious and more serious in recent days. And what we've heard today is that Prime Minister David Cameron saying that the new plan, really the terms of the EU membership deliver what he says is a substantial change. Those are his words. The document that was presented by Donald Tusk is a response, a direct response to 4 specific points that David Cameron was looking to see reform in. This includes more autonomy on issues of immigration, specifically measures that would allow the UK to hold back welfare benefits to migrants from the EU for up to 4 years. Also, to some rules that prevent EU migrants from entering the UK. Some of the other provisions that we have up here on your screen, you know, they outline recognition that the UK is not committed to further political integration with the EU. Other reforms deal with matters of controls over economic competitiveness and and issues with respect to sovereignty. But based off of what we're learning this week, it really seems as though Prime Minister Cameron and European Council President Donald Tusk are getting closer to finding a compromise that would keep EU membership in place. But ultimately, all of this is going to depend on that national referendum that's expected to take place here in the next few months.
Is it in the next few months?
Right. Well, the scheduled date for that now is June 23rd.
Oh, wow. Wow, that's incredible, because I know that he had to have it done by 2017.
2017. That's the promise that he made if the party won again in 2015.
Right.
Of course, they won, and so they said that they would have that done by 2015, and it's likely to be something that happens within the next few months, as early as June.
So he's trying to follow through with his promise. Well, this issue is certainly creating a rift. It's been very difficult for Prime Minister David Cameron to sort of keep the reins on his own party. I mean, what can you tell me about that?
Well, no, that's absolutely right. And there's quite a bit of doubt, quite a bit of skepticism, even within members of his own party, like you mentioned. Things work very differently in British Parliament than they do here in Congress. And what we're hearing, the kind of language from Conservative MPs, members of the Prime Minister's own party, it's really fascinating, at least to me. I've heard Conservatives call the proposals by the Prime Minister pint-sized. When somebody said that they were, quote, the equivalent of polishing poo. I like hearing this kind of stuff. It's different. But I want to read you a quote from Liam Fox. He's a Conservative MP who says that the reforms have been watered down. This is what he said. He said, quote, "None of these changes even come close to the fundamental changes promised to the public. We are being asked to risk staying in the EU based on the back of empty promises from the EU that are not even backed up in treaty." And we're seeing similar sentiment across the board here, meaning that as challenging as it's going to be for Prime Minister Cameron to get all the EU leaders to agree on this, is going to be just as challenging getting members of his own party on board with this. Right now, that document that we're talking about from Donald Tusk, it's the foundation for the negotiations, diplomatic negotiations that are going to be taking place in Brussels later this month. I believe the dates are the 17th and 18th of February. But if things go well there for David Cameron, the next phase is getting Parliament ready to hold that national referendum later this summer.
Indeed. Now, as we know, there's some growing concern also amongst investors over this as well, and we've been seeing markets sort of be skittish. I mean, as this referendum really does draw near, how are the markets expected to react? Right.
Well, you mentioned in your introduction there that this is causing concern with investors and UK citizens alike, and that's absolutely true. So I want to point to a poll that was actually conducted late last year by Bloomberg, that they were asking economists what the #1 risk to UK growth would be in 2016, and 43% of economists said that it was the Brexit. That's the #1 risk. So from a foreign investment perspective, the concern over the Brexit really has everything to do with uncertainty. Not counting the impact that this could have on the British pound, not counting the impact that this could have on the valuation of companies in the UK, what we're likely to see is investment take a step back until the dust settles from that referendum. And that in itself isn't good for the UK economy. Anytime uncertainty is this high, the issue becomes front and center for investors. That's what we saw in the lead up to the Scottish referendum.
Right.
And with the Brexit, what we're going to need to do is wait until we get closer to that June deadline and really see how that affects the markets.
I'll tell you, between Brexit and then the potential sort of challenge we're seeing for the Schengen zone, lots of problems ahead, unfortunately, for the region. Manny Rapolo, thank you so much for that reporting.
Thanks, Samir.
All right, time for a quick break here, but stick around because when we return, Jim Rickards tells us how much he thinks the Chinese renminbi might depreciate if it floats. Then in today's Big Deal, Ed Harrison and I are talking about investments as European corporate bonds edge closer into negative territory. That's on the other side. Stay with us. And as we go to break, here are the closing numbers at the bell.
For decades, the American middle class has been railroaded by Washington politics. Big money corporate interest has drowned out a lot of voices. That's how it is in the news culture in this country now. That's where I come in. I'm Ed Schultz. I do the news on RT America. I'll make sure you don't get railroaded, and you'll get the straight talk and the straight news. Question more.
Most people think to stand out in this business, you need to be the first one on top of the story or the person with the loudest voice or the biggest ratings. In truth, to stand out in the news business, you just need to ask the right questions and demand the right answers. Question more.
You're watching an RT America special report.
Man, it ain't about him. It's about you. It's about me. It's about everybody.
Basically, everything that you think you know about civil society had broken down.
There's always going to be somebody else one step ahead of the game.
We should not be in the business of normalizing violence.
We don't need people that think like this on our planet. This is an incredibly tense situation.
Welcome back to the show. The International Institute of Finance reported that $735 billion in capital left emerging markets in 2015, and a whopping $676 billion of that came from China. To get his take on that, Jim Rickards is back on the show, and Jim is the editor of Strategic Intelligence. He's also the author of the new book, The New Case for Gold. Jim has said that China is facing a full-blown FX reserve crisis. So I first asked him, shouldn't $3 trillion in reserve act as really a significant buffer to that? And here's what he had to say.
Remember, the $3 trillion used to be $4 trillion. The problem is, the problem when you get capital outflows, it's never enough. $4 trillion, which is where they started, seems like a lot of money in a steady state, and it is. But once people lose confidence, once the money starts to go out the door, it actually accelerates. It's non-linear. So, okay, they lost close to $1 trillion last year. That doesn't mean, in worst case, they'll lose $1 trillion next year and $1 trillion the year after. It'll actually accelerate. It's like people running out of a burning theater. You know, the more panic there is, the more people run for the doors. So this will actually pick up. China will be broke, meaning the reserves will go to zero, by my estimate, by the end of 2017 if they don't do something. Now, clearly they're not going to allow that to happen. So as an analyst, as a policy maker, you basically say, well, what are they going to do? How are they going to stop it? Well, there are only three ways to do it. One is you could raise interest rates really high to keep the money at home. They're not going to do that because it'll sink their economy. The other one is you could slap on capital controls. They're starting to do that in small ways, including threats and intimidation, but they can only go so far because, remember, they just joined the IMF SDR club. Right. They have to make nice to the IMF. The third way to do it is devalue. Just let your currency float, in which case the currency would go down. Now, they're getting criticized, but this is called the impossible trinity. You cannot have a pegged exchange rate, independent monetary policy, and an open capital account at the same time. It's impossible. If you try, you will fail. Something will break. So the analytical question is, what's going to break first? My view, they'll devalue the currency. They'll get away from the peg, and it'll go down. It's going down a lot already, but it'll go down more.
Yeah, I'm going to ask you just about that in a moment here. I want to ask you about this group that's now projecting the losses for 2016, saying it'll be about $450 billion leaving emerging market economies. But given the trajectory that you're seeing China on, do you think that sounds like a really lowball projection?
I think that sounds low. But remember, the Chinese economy is deaccelerating rapidly, so that whole game is up. And by the way, to get your money out of China, you have to be among the elites. You know, you have to be a princeling or a Communist Party official, head of a state-owned enterprise, extremely wealthy. You need some kind of connections. They're starting to clamp down on some of that. They're arresting people. Remember, the Chinese still use firing squads. We don't use them in this country, but they have coercive techniques for getting what they want. But people are playing games with invoicing, going to casinos in Macau, losing on purpose, paying the casino operator a kickback, getting the money out, paying too much for assets abroad. We see it everywhere. I mean, I go around the world. Melbourne, Sydney, Vancouver, Istanbul, Rome, London, New York. It's the same story. The Chinese are buying up everything. They're getting the money out as fast as they can. The point is, it accelerates. It doesn't go, I don't know where these linear projections come from. I just look at a currency crisis. Mexico, 1994. Russia, 1998. Argentina, 2001. They're all the same. They start out slow and they snowball.
Right. And the question is, where is all of the money going to? I mean, people are taking their money out and they are putting it where?
Well, we know about the real estate story. They're buying high-end, Belgravia, Mayfair, and New York and all that. One of the interesting stories, Mary, is people say, well, gee, if China has to sell dollars and buy yuan to deal with the capital flight, doesn't that mean they're selling U.S. treasuries? Doesn't that put upward pressure on U.S. interest rates? Well, the answer is, yeah, they are selling U.S. treasuries because that's where the dollar comes from. But then when the people get their money out and go to, let's say, Vancouver, they take it and they buy treasuries. You know, for every seller, there's also a buyer. So one of the reasons we're not seeing pressure in the treasury market, we're not seeing U.S. interest rates go up, even though the Chinese government is selling treasuries, is that the Chinese people are buying them once they get to Canada or the U.S. or wherever. So it's just a two-way street.
Yeah, that makes sense. What do you think, you mentioned the options that are ahead for China. What do you think President Xi Jinping should do at this point, at this juncture?
Well, he has no good choices. I mean, what they should do is just let the currency go where it's going to go. I mean, if they put on capital controls.
Let it float.
Yeah, let it float. I mean, it's sort of a dirty float or managed float. There are different names for it. They're somewhere between. It's not a pure floating currency, but it's not. But they are letting it go down. But they actually don't know what to do. See, the problem is they're communists. People forget because it's a capitalist society. No, it's not. It's a communist society. It's top down. It's controlled by the Communist Party of China. They're babies when it comes to capital markets. They're still figuring this stuff out. So they're making a lot of mistakes. It's like a kid learning to walk. They're going to fall down a few times. They did that in August when they shocked the market with the initial devaluation. Now, then they sort of wised up November, December. They did all these little baby step mini devaluations, but then they pushed that a little too far. U.S. markets started going down, so they stopped the devaluation game, tightened down on the capital controls, but that's only going to get them so far, so they're going to have to go back over to devaluation. They don't really have any good choices. The problem is everybody wants their money out.
You think he should let it float, but the question is, would he do that?
He'll have no choice. What are you going to do? You're going to sit there and let the capital account go to zero? Let your reserves go to zero? They're not going to do that.
Right.
Are you going to raise interest rates? Well, they're not going to do that because the economy is slowing down. So there's only one thing left.
Left with no choice.
Devaluation, yeah.
Now, I would ask you how much do you think it would appreciate or depreciate, but I think I'm getting the sense that you think it would only depreciate. The question is, by how much?
Well, it probably 10% or more.
Some people have said 30%, 50%. Do you think that's too far?
Well, 50 sounds like a lot. I mean, there is a look. China's not falling into the Pacific Ocean. There's a real economy there. There are investment opportunities, but it's all about entry points and exit points. So this thing, I would say, the longer they fight it, the worse it will be. That's the history of exchange crisis. Okay, the Bank of England, 1992, fighting George Soros. Well, George Soros won because he was able to sell sterling longer than they could sell dollars. The Bank of England had a finite amount of dollars. All Soros had to do was, know that Germany wouldn't rescue them, do the math, borrow enough sterling, and just sell it into the market, and they eventually went broke. So the problem is it feeds on itself. And they'll start to panic when they'll lose another trillion, and then they'll either shut the doors or let the currency devalue. I think they'll devalue before then because they don't want to lose the money.
Big deal time. I'm sitting here with Ed Harrison, and we are talking about investments from oil to corporate bonds. On Tuesday, Deutsche Bank strategist Jim Reed said it was only a matter of time before yields on corporate bonds sold by European companies dipped into negative territory. While at the same time, we heard today that the energy sector was dealt yet another blow, with BP seeing its biggest loss in at least 20 years. And Ed, we know that oil prices are just catastrophic right now, down 70%. Looking at this from a long-term perspective, can they really go any lower?
I mean, they can go lower, but I think that there are a decent number of people who are looking at the prices at $30 a barrel and saying that however low they go from here, they're not going to remain at those levels so long, and that we're at a point where you might start to accumulate, if not oil straight up, then at least those parts of the oil sector that are good as a longer-term investment.
So the thought may be that we are sort of near the bottom.
Yeah,
okay.
For a long-term investor, we're near the bottom for well-priced companies.
Okay, despite the oil tanking, we're hearing whisperings right now that Warren Buffett is investing in Phillips 66, now specifically investing in the midstream chemicals refining and marketing part of the oil business. So what's the thought there? I mean, is it that, that part of the business is supposed to be insulated from the downturn?
Yeah, there's some thinking that that is the case. I mean, there's certainly more volatility and there's more leverage to the oil price if you're in the exploration and production side of things versus if you're in midstream and refining and marketing, there's less leverage to that. And one of the things is that obviously if you're refining and marketing oil, then oil is an input. So you're insulated to that degree, but refining margins go down. during this particular, these kinds of phases. We've seen this 1 or 2 times before. Look at Valero Energy. They just reported earlier this week. They had a number that was in the order of $250 million versus $1 billion, so that's a 75% cut to what they're looking at. But these companies, they trade at really low multiples. Phillips 66 is trading at 9.3 times earnings, so now is a good time for people to accumulate if the price is right.
It seems a little risky, though, and we're not all Warren Buffett, so
right. But
I don't know
if you're
if we
looking
can...
at it over the longer term, and you think that this is a trough or near a trough, and you're not exposed to the fluctuations in oil prices, but rather the fluctuations in refining margins, that's a much better business.
So that's a fair point. Let's talk about corporate bonds. Yields are extremely low right now. Can they go any lower?
They can go lower. In the United States, the question is will they go lower? Because obviously in the U.S., the question is where are we going to be in this rate hiking cycle? But on the corporate side, you could have shrinkage of the yield curve could actually flatten over time. I think the yield curve will flatten over time, and that means that we're going to have a maximum number of rate hikes, and then they're going to stop. But then the lower end is going to come in as a result of a sense that the economy is stalling to some degree.
Right.
And so I think that, yes, you would want to get into corporate bonds on the long side, and that might be a good play over the longer term.
Outside of the U.S., I mean, this is already a very real thing in Europe. And in Switzerland, low-risk corporate bonds have negative yields because the government bond yields are negative. Some people are talking about the same thing actually extending to the Eurozone. How do you see it?
Yeah, I think that is what's going to happen because we saw across the curve that Swiss government bonds have gone into negative territory. Now it's out to 10 years. We're going to see the same thing with the risk-free asset class, which is German bunds in the Eurozone. And when German bunds start to move more negative, and this is a perfect example of what I'm talking about, as expectations for lower rates on the short end continue out, you're going to see a flattening of this yield curve, and that's going to mean lower government bond rates and more government bonds higher down the yield curve in negative territory. And eventually, that's going to tip over into corporates. There's no reason that they can't do it.
And let's just be clear that this basically means investors have to pay these companies to park their money.
Right,
if it's
exactly.
Negative. Right, which is, to me,
I
still I'm not really sort of grasping that concept. But tell me, I mean, who might join them? I mean, there's talk of Japan. What do you think about Japan? What do you think about other countries?
I think Japan could join them. I just talked about the U.S., but certainly the other countries that have negative rates already. We're talking Sweden, we're talking Denmark. We already know about Switzerland and the Eurozone. Those are 4 countries that are now their central banks with negative interest rates.
Wow, it's incredible. And on the flip side, where might we find the highest yields, the furthest from the zero lower bound?
So the places that still have the furthest to go, that I call the places to invest because everyone is converging towards zero, are Australia and New Zealand in particular. The Reserve Bank of Australia had their rate decision today. They did not take their rates down. They're at 2%. They're even higher in New Zealand.
All right, there you go. Very good advice for all you investors out there. That's all from us. We love hearing from you guys. So tweet at all of us, Edward NH, this guy right here, Bianca Ficini, Manuel_Rapolo, and yours truly, Amira David. Remember, you can see all the segments featured in today's show on YouTube, youtube.com/BoomBustRT. We'll see you next time.